Hi, my name is Michael Blake, and I'm president of Arpeggio Advisors in Atlanta. And this is a recording of a presentation on managing to value as opposed to benchmarks. Now, I gave this presentation earlier today, April 19th, 2016, to a group here this morning. The recording really wasn't so much the recording didn't take, but because there was a lot of interruptions for lively discussion, the flow of the presentation would have been confusing if you weren't actually in the room. So I'm re-recording this as a webinar. If you happen to be one of the people that saw the original presentation, you may notice that some of the slides are out of order, or seem to be. After that presentation, I decided that switching the order of the slides made the presentation flow a little bit better. So you're not crazy. I did change things on you, but I'm sure you can keep up. So as I do for all my presentations and webinars, I have fairly standard disclaimers. Some of them are glib, some of them are serious, but the upshot is, I'm doing this presentation to provide a community service. I'm not being paid to do it. Don't expect to be paid to do it. Not doing it on a necessarily professional level, but merely as a way to share my views on a particular topic in the hopes that somebody else who has an interest in that topic may find this information useful, or at least at a minimum thought-provoking, and give rise to consider some of the ideas offered here. So for this topic of discussing how to benchmark or manage a company for value as opposed to specific benchmarks, I'm offering the following learning outcomes. One is to establish a definition of value. What does value mean? And value is such a squishy definition that any time that I talk about valuation, it's worth spending time on establishing a common vocabulary. We'll talk about how the term shareholder value has become a dirty word. It's gotten kind of a bad rap in the last several years. We'll make a distinction between key performance indicators and key performance drivers. We're going to talk a little bit about the City of Atlanta public school test cheating scandal as an example of how improper benchmarking can accomplish exactly the opposite of the effect desired, and then how to measure the value impact of management actions versus environmental changes. What are we going to give management credit for, and what happened as a result simply of conditions over which management had no control? So my favorite definition of value, at least right now, is that the value is the most frequent price paid for the same or identical asset if it's bought and sold frequently enough. And I should probably say parenthetically, in a relatively short period of time. And so if an asset is bought and sold a number of times, or an identical one, there are going to be people that overpay for the asset, which would be to the right side of the bell curve, maybe underpay, or more precisely, sellers undersell. So in the market, people get good deals, they get bad deals. And value suggests, to my mind, that the price that most people wind up paying, accepting, is kind of a democratic way of establishing what value is. Because value is not something we can directly observe. It's something that we make, frankly, very educated guesses or estimates of. That doesn't mean the valuation exercise is not useful. It is. There are many things in nature that we observe indirectly as opposed to directly, but we still know that they're there. Black holes is perhaps one of the most obvious examples in science. But I do think that this is a fairly viable definition. And so if you're in the middle of this bell curve where half the people are paying more, half the people are paying less, or something of that nature, then whatever that middle ground is, whatever most people are paying, accepting, is most likely a reasonable indicator of value as opposed to price. And I hope you agree with that definition. And I'll go over some common misconceptions of value too, because it's important to understand what these misconceptions are and why I think they're misconceptions, so that you can really kind of buy into my definition of value. That's important to this discussion. So one common misconception is that value is what somebody is willing to pay for an asset. And this is an argument that investment bankers like to use, sometimes venture capitalists, private equity guys. And I think it's a spurious argument because by that definition, if I say that I'm willing to pay $100 for the entirety of Google, that therefore Google is worth $100. That of course, is an absurd answer, an absurd example, yet taken strictly at its face, that's exactly what the statement values that someone else is willing to pay, right? And so to me, that definition just doesn't make sense, and it can be pretty easily defeated. Second is that value can be created overnight. Generally speaking, value cannot be created overnight. Even things that look like they're created overnight weren't. They're almost certainly the result of months or years of labor and positioning and thought and development before the value simply became apparent. And finally, there's a misconception that valuation is a so-called dark art, which is, I think, a nice way of basically saying that business appraisers make semi-educated guesses. And quite candidly, I think that what we do is more than that. Is there some guesswork involved? Yes. Is the entire process of business valuation reduced to a science? No. If it were, a website would be doing it and people would not. But that doesn't mean that it's a purely random outcome that is equivalent to shaking a magic 8-ball or consulting a Ouija board. There is, if it's done correctly, there is quite a bit of rigor involved. So where does value come from? You'll find lots of opinions on this, but I think value comes from two primary groups of forces. One is sustainability, and the second is accumulation. Sustainability really refers effectively to the income statement, the extent to which cash profits are sustainable, growth is sustainable, superior margins are sustainable. Those are things that all create value, and superior margins implies it's a non-commodity, for a business at least. Whereas accumulation refers to a balance sheet, or at least elements that might be on a balance sheet if our accounting systems were sophisticated enough to record them. So I think that value generally comes from the accumulation of customers, intellectual property, and talent. Now, can you quibble with this list? Absolutely. I'm sure that it's not exhaustive, but I do think it's a pretty good first cut. And this may be one of the areas that you, as the viewer, choose to apply your own thought and either agree, disagree, refine, and that's great. Now, the thing about building value that makes it so attractive is the multiplier effect. If we add some profit or some element to a company on a temporary basis, then that element or that asset, if you will, has a fleeting characteristic, and generally speaking will not be particularly additive to value. And in fact, most competent financial analysts will make adjustments for extraordinary items, for unusual items, and will recognize them for what they are and try to isolate the value of the company from those short-term influences. Conversely, sustainability of something is what drives the use and validity of valuation multiples, such as price to earnings or invested capital to earnings before interest, taxes, depreciation, and amortization. Anytime you have a multiple, that is a market that is making a statement for how durable and reliable that economic benefit, whether it's revenue, pre-tax profit, after-tax earnings, free cash flow, whatever it is. And the market's making a statement as to how durable or how long that flow of benefit can be counted on by the buyer or the current shareholder. And so what factors into valuation multiples are permanent or at least long-term changes. Multiples will move when there's some secular structural change, either in the company or in the market, or often both. And that will change valuation multiples that will move a company's value up or down. And here's an illustration of the multiplier effect. A company with $1 million in after-tax earnings generates $250,000 in additional earnings thanks to some one-time projects that allow early revenue recognition and cash collection. However, the market recognizes that the earnings are not sustainable and assigns a $250,000 value to the one-time windfall, which then disappears in the valuation shortly after that date. The company could have spent the same effort to undertake projects that would have generated $100,000 a year in after-tax earnings over a 10-year period. And if we were to apply that $100,000 benefit in after-tax earnings to a discounted cash flow model, if we have a cost of equity of 25%, the company's value would have increased roughly $357,000. Now, I will spare you the discounted cash flow analysis and the Excel excerpt. You can either trust me that it's right, or if you want, feel free to grind the numbers out yourself, and you should get the same answer that I do. But the key here is that we have a multiplier effect. We have a one-time increase in earnings. The market largely ignores it because they don't believe that it is sustainable, and therefore that one-time earnings is a nice bonus, but it does not change value in a material way. On the other hand, when a company undertakes projects that lead to durable benefits that are repeatable over a period of time, then the market does recognize that value because it can be counted on in the future, and valuation is all about predicting the future. So to kind of sum up, where that one-time benefit is put in the past as soon as it occurs, the expected flow of future benefits, i.e. that those $100,000 a year in additional after-tax earnings over a 10-year period, are expected in the future, and value is based on the future, and therefore that moves the needle in terms of business value. Now, there's nothing inherently wrong with most benchmarks, as long as they're actually connected to value, which they frequently are not, as long as they are indicative of short and long-term corporate health, which they often are not. They're always independently monitored, which they rarely are. That you never have labor turnover. That's rarely the case. Leadership focuses on the business and not on scorecards. That sometimes happens. And leadership focuses on innovation and operation, not on financial engineering. And again, that sometimes happens. So benchmarks aren't inherently bad. I just think that in many ways they're inferior to managing to value, which is really the point. And over the last several years, benchmarking has gotten such a bad name because it's associated with bad things, right? Even Jack Welch, once a name synonymous with so-called value creation, has now gone on record calling it the dumbest idea of the world. And Paul Pullman has branded building shareholder value as a cult. And Lynn Stout, who's a law professor at Cornell University, calls it a myth. Now, the hijack actually started occurring in 1976 when a very important paper was published called The Theory of the Firm. And in that point, market capitalization became synonymous with shareholder value. And I understand why that occurred, because in the 1970s and beyond, there was concern that managers were kind of using shareholder money to promote their own interests and not necessarily those of the shareholder, and therefore the ultimate arbiter of value add by management is going to be market capitalization. But that only works if you assume that the market is fairly efficient, actually highly efficient. I actually don't make that assumption. I think that it is efficient to a point. I think market eventually does match up price to value, and that's ultimately what efficiency means. But it doesn't always do so immediately and in a short period of time. And so there's become a disconnect. And so consequently, there's been a belief that corporate managers, in fact, are at odds with their own shareholders. In theory, managers are supposed to be working for the shareholders, but so disconnected became the relationship between management and ownership that it has led many academics and business people and observers to question whether or not shareholders actually own the firms in which they're shareholders, which is an extraordinary belief, really seismic, right? Because it basically says that if you own shares in a company, you're a sucker because you don't really own it. You have some sort of vague claim on a company. If it goes under or if it gets sold, you get a piece of the action, you get a piece of the dividends, but you're not really an owner. And this has been brought to a point historically because managers have on occasion over many periods exhibited a tendency to build empires, and in doing so destroy value for the shareholders. But they're taking shareholder money to increase their own influence, to increase the size of the companies, and I'm sure at least there's a desire to increase shareholder value, but many acquisitions, in fact, are value destroying, and current theory suggests that horizontal acquisitions, i.e. acquisitions that seek to diversify over varied industries, tend to not be very good for shareholders. And the reasons for that fall outside the scope of this webinar. But if you're curious about it, Google it. You'll find numerous papers that discuss the matter in detail. So I'm going to hold up the Atlanta schools as an example of benchmarking at its worst. And this is nothing against the Atlanta schools. We've lived in Atlanta for 13 years, and frankly, we love it here. But for good or ill, we had these scandals. And the interesting thing about the scandal is that it is not that dissimilar to the Chicago schools' own cheating scandal in the 1960s, under similar conditions as detailed in the book Freakonomics. So history does have a tendency to repeat itself, especially if the conditions for repeating itself manifest themselves. So as a result of the No Child Left Behind programs, the Atlanta public schools, and really schools throughout Georgia, created so-called CRCT tests, or Criterion Reference Competency Tests. My own kids take them. And the results of those test scores were given 50% weight in reviews of educators and principals. So the test scores were really important in terms of compensation, promotion, job security, and so forth. And numerous reports, including reports on the internet and from the Atlanta Journal-Constitution's own investigative reporting, suggest that this desire, this obsession with meeting benchmarks created a culture of fear, intimidation, and retaliation throughout the school district. Now, in spite of all this, the Atlanta Public Schools showed many years of improvement in the years that benchmarking or the CRCT standards were implemented. And Atlanta went from being known as one of the worst public school systems in the country to being effectively an educational miracle and suddenly being held out as one of the best. So, of course, as residents of the Atlanta area, it was deeply disappointing to us to learn that those test score improvements were a mirage. With 178 educators implicated and 13 in the process of being convicted as I record this webinar. And numerous bad things happen as a result of this, but perhaps the most damaging is that many students likely advanced to higher grades without the qualifications to do so, which is going to set those students up for massive failure as they advance and as they age. So the scores were great, but the educational outcomes weren't. So we had benchmarks that did not work particularly well. Now, why would you cheat? And I guess I'm digressing a little bit here, but it is worth kind of taking a break here. And again, Freakonomics discusses this a lot better than I do. But in effect, there is a no-lose scenario, because if teachers think that their students are going to be skilled enough to pass the test on their own, then great, they win. There's nothing that they particularly need to do. On the other hand, if the students are not likely to pass, if you're not confident they can pass these tests at the rate required, then, and you don't cheat, then you lose. You're going to be blamed for their failure. On the other hand, if your students are not likely to pass and you do cheat and you are successful, then you win. And if your students are not likely to pass and you cheat, but you do get caught, you lose anyway. So if you kind of look at the decision characteristics here, if you don't have confidence that your students are going to do well in those exams, you almost might as well cheat. Now, I'm not sure the teachers thought that they had a realistic chance of going to jail. That may change the calculus quite a bit. But absent a fear of going to jail, if you think they're going to cheat, if you think that they're not going to pass the test, you might as well cheat, because if you're going to be fired anyway for a student's failure to pass the exam, right, you might as well take the shot that you might blow one by them, personal and professional ethics aside. And really the only time it doesn't pay off to cheat is if you miscategorize or misevaluate your students' ability to pass, and if you cheat, even though your students could have passed without your cheating, that's the only lose-lose. That's the only true loss scenario for the teacher. And so consequently, there's a very high temptation to cheat, to which several individuals gave in. And so the consequence of the cheating scandal is that educational outcomes are substandard. Who knows how many kids we have that are still in the system, have graduated from the system, that just simply have not received the education they need to function and succeed in our society. It also leaves big messes for the next person to come in and clean up. And, who wants to do that? It's a thankless job to come in and clean up somebody's mess. There's reputational damage. If you're a good teacher in the Atlanta public school systems that did not cheat, how do you feel? Or if you're thinking of applying for a job in the Atlanta public school system, how do you feel? Do you really want to work in an environment that is susceptible to that kind of environment? And there's even more of a hyper focus on short-term accountability, right? In an extreme case, it's effectively a witch hunt. But even absent that term, if you're in a turnaround situation, you're not managing your business or your organization year to year or quarter to quarter. You're doing it month to month, week to week, and sometimes day to day. And that's not necessarily a value building exercise, because you're focused on survival. You're focused on trying to make sure the value doesn't go below zero. And those are not scenarios that set you up for value creation. And this is relevant because I believe that managing to benchmarks is like managing to test scores, whereas managing to value is like managing to learning. You're concerned about the ultimate outcome that may or may not be all that easy to measure. Managing to benchmarks often leads to a mess for somebody else to clean up, whereas if you're managing to value, it means that you must have a longer term view, and therefore you must stick around and be accountable and be in a position to clean up your own messes. And so I think that this prompts a need to shift our thinking from key performance indicators such as test scores to key performance drivers. And what I mean by that is that key performance indicators tell you the results of things that you think are good: customer retention, employee turnover, new customer revenue, realization rates, return on capital employed, days accounts receivable, warranty claims, Yelp reviews. All of those are key performance indicators that show how well you're not doing. And that's all well and good, but I would invite you to think about key performance drivers. To what extent are employees doing the things that are necessary to produce positive key performance indicators? Because those are the harder things to do. And they're also the elements that are fully under control of the company or the individuals in the company. The company can control whether or not it's going to touch customers to appreciate their business, to conduct employee surveys, to make outbound sales calls, to produce a product efficiently, to publish newsletters frequently and on time, to make a conscious decision to spend resources and time on training and team building. Right? Those are elements where the results will not be known necessarily right away, but if they're chosen correctly, they're absolutely the kinds of things that will lead to an increase in value of that company over time. And quite frankly, they're also easier to manage in real time. Once a key performance indicator is out, then it's out, and you probably have a fairly significant lag between the actions that led to those indicators and when the indicators are known. Key performance drivers are much easier to measure in real time. You can look on a day-to-day basis. How many customers did you talk? How many sales calls did you make? And those managing those key performance drivers are the things that create sustainability and accumulation of assets. And therefore, managing these drivers is likely to be a much more productive exercise than managing to these KPIs or key performance indicators. And this is reinforced by recognizing the difference between individual versus firm goals. Individuals are running a firm on behalf of somebody else, and the interests aren't aligned. There's a big difference between a company not increasing in value and somebody's job not being secure. And individual goals tend to be much more short-term because they are necessarily. Firms, frankly, can last longer than many people do. Even if a person stays in the company their entire lives, the company can easily outlive that individual's work life, their biological life, and many generations. Think about the Coca-Cola company. You could easily have sixth generation Coca-Cola employees under the right kind of circumstances right now. And so job security is important to individuals, or being attractive to the next employer, especially nowadays where lifelong employment is dwindling rapidly, and for most people it's a pipe dream and maybe not even all that attractive. We look at, people tend to worry about this year's compensation this year and next year's compensation next year. And maybe individuals will have a goal of searching for acquisition targets because buying companies is sexy. And buying companies also can make your numbers look better in a short-term way. And in some cases, at least an easier way in the short term. Whereas firms are concerned with organizational viability. They're concerned about being attractive to the next customer. And that may be a value proposition. It may be your relationship with the community or various stakeholders. It could be your labor relationships. All those things go into being attractive to the next customer, not necessarily the current one. The firm goals may be to build a prestigious brand, speaking of Coca-Cola. And that's not something that happens overnight. It's not even clear necessarily how it happens, only that it happens. Cash flow over a 10-year period, that might be a good firm goal. Well, over a 10-year period, you might turn over half the people in your firm, if not more. And then listening to potential acquirers is a good firm goal. If you're really on the lookout to build shareholder value, right, then you should be thinking about or always entertaining offers from legitimate potential acquirers, because that may be the best path to maximize shareholder value, even if the acquisition is going to put your job in jeopardy. When you sign up to be an organization, that's your job. But not everybody lives up to it because the incentive structures are not well enough aligned. And this brings to mind kind of a laundry list of other value-building tasks that I think are thankless, but nevertheless are highly important, as so many thankless jobs are. Right? Making your company one of the best places to work can be a great value builder because it helps you attract and retain talent. I don't think anybody would argue that attracting and retaining top talent is not accumulative or accretive to a company's value. Improving corporate training procedures is important to a company's value. Again, better skilled workforce. Upgrading data security. Data security is not sexy, although it's a little sexier than it has been in the past. But boy, in 2016, making sure your data is secure is really important, even though it's a low-profile job. Getting your financials audited is a good way to build value. Making yourself more transparent to potential acquirers, to creditors, and frankly, even to your own management board. It's a thankless job because it spends money, and it's unpleasant, and the auditors may very well uncover things that you'd rather not have uncovered. But that's why the very fact that you make yourself vulnerable in that way is what enables value to be created. Building a social media presence, especially by encouraging reviews, is a thankless value building job because the results are not immediately known. Building a social media presence is a months to years long undertaking. It is not something that is going to show instant results. Cannibalizing sales is definitely a thankless value building job. Right? There's a saying, better to cannibalize your own sales and have somebody do it for you. But if you're going to do that, then you're taking food out of somebody else's mouth, of some division, some operation that is going to lose as you win or as the firm wins. That's definitely a thankless job. And sharpening your intellectual property, or just refining and reinforcing your intellectual property is, have somebody review your patents, because many patents are in fact worthless, and some are even harmful. Some just expose the company to attack for no particular reason. Again, that's a thankless job, but it is one that can significantly lower the risk of the company, and lowering risk can be just as powerful to value building as building profits and accelerating growth. Take an example of a firm, an accounting firm that has an opportunity to sign a $500,000 client, but that client is in conflict with an existing client that represents $10,000 in annual business. And think about partner compensation that's 80% driven by annual revenue under management. Now, one of the things you learn in professional services, and I had to learn this, is that if you want to understand what a firm is going to do, if you understand what a partner in a firm is going to do, look at their compensation plan, their compensation agreement. And that's what's going to get done. That's what is going to drive behavior almost every single time. The firm is great, but I got to pay for my kids' college. I want that second home. I'm behind on my retirement savings. And if it's a choice between me and the shareholders, even my fellow partners, it's going to be me, right? And so you may have an organization where the equity partner says, you know what, you can't fire the $10,000 client. You can't make me fire them. I'm a partner in this firm. And if you do that, then I'm going to make a lot of trouble. And so the client winds up being turned down and goes to a competing firm. So was that maximizing shareholder value? Probably not. But it's a reality of what happens in the real world, not just in accounting firms, but law firms and other professional services firms. In particular, those where compensation is determined very heavily by individual books of business or individual reporting unit performance. So what does matter more, revenue or profit? And the answer is that, candidly, it depends. But the good news is that we can actually find out from the public markets what matters. Take a group of pharmaceutical companies. These are all real-world companies, or at least they were at some point. And you can see their enterprise value to revenue, enterprise value to earnings before interest, taxes, depreciation, and amortization. And below that grouping, we've got several measures, statistical measures, including measures of central tendency, mean, median, harmonic mean, and so forth. So how do we know which indicator is most important in terms of value in the marketplace? And the answer is that it's actually deceptively easy. In particular in this case, because we have a full data set for revenue and a nearly full data set for EBITDA. And the answer is the lower coefficient of variation governs. The lower coefficient of variation, which is simply standard deviation over the mean, suggests that if you were to do a scatter plot of these multiples, that they would exhibit a tighter dispersion. And that tighter dispersion is widely understood to mean, or taken to mean, that the market values companies more consistently using that multiple than other multiples. Now, another concept that's important here is the concept of parsing value. And parsing value is making a distinction between what's under the firm's control and what is not. Right? Did a company's value increase because it got lucky, or did it increase because of specific things that executives did? And so items under the firm's control would be operational efficiency, hiring, lessening dependence on key persons, securing better financing terms, innovation. There are others. This is just a quick list. Whereas environmental factors would include interest rate changes, commodity price changes, a customer being acquired, changes in competition, private equity firms start to buy up competitors, right? Management has nothing to do with any of those things. And so let's look at an example of how we parse value to make an assessment as to just how much management should be rewarded or not rewarded in return for an increase in shareholder value. So a company today has a fair value of $28 million. And over some period of time, it doesn't matter what, the Fed raised interest rates by 0.5%. Industry growth increased by 1% a year and is expected to trend that way in the future. The company's own growth rates are expected to increase by 1.5% this year and in the following 4 years. EBITDA margin increased by 1 percentage point, or 100 basis points, for the foreseeable future due to successful training programs and reduced employee turnover. And as a result, over this period of time, again, does not matter what it is, call it a year if you need one, the value of the company increased to $30.8 million. And by doing some sensitivity analysis, we can measure the value impact. So the Fed raising interest rates reduces the value of the company by $650,000. That's because as interest rates goes up, cost of capital goes up, discount rates goes up, time value of money goes up, and therefore future cash flows are discounted more heavily than they otherwise would be. Industry growth is up 1%, which leads to a value increase of $1.2 million. Company growth is up an additional 5%, which is a value increase of $600,000. And EBITDA margins are up 1% across the board for an increase of $1.65 million. So what credit should we give to management for these dynamics or these events? Well, clearly management can't be blamed for the Fed raising interest rates, so we're not going to punish them for that. Although the company's growth is up by 1.5%, the whole industry growth is up 1%. So I wouldn't give credit to management for simply keeping up with the rest of the industry. In fact, I would punish them if they failed to do so. But happily, it turns out that they actually did manage to grow. This is a typo here. It should be company growth up 0.5% over the industry. of 0.5%, and that does lead to a value impact positive of $600,000. And an EBITDA margin, the EBITDA margin being up 1%, also leads to an increase of value, and I think we can give the company credit for that. And so management should get credit for a $2.25 million growth in value. Excuse me. Don't know how to hit the mute button here. So, to wrap up, how do we take some of this information and put it to good use? Well, if you want to use benchmarks, go ahead, but measure in terms of years rather than months or quarters. And therefore, the benchmarks are much more likely to align interests with value building rather than short-term scorekeeping. I firmly believe that focusing on key performance drivers is far more meaningful than key performance indicators, for the reasons I've said. That it's easier to manage, and there's a much closer connection between employee effort and activity and building value, ostensibly through some profitability or some accumulation of assets. Make sure that you discern between purposeful or intrinsic and accidental or external value creation. Did the company increase in value because the management did specific things you can trace to their behavior, or did they get lucky, or is there some more likely there's a combination of the two? And so it's important to separate those two. And incentivize based on value creation and not key performance indicators. And of course, for any of this to have any meaning, you have to measure value. Right? None of this matters at all if you're not able to measure the starting value and the ending value and measure what the ultimate sources of change of value were. So this is not being done live, so unfortunately I don't have a chance to ask questions, but I hope this has been informative to you. If you're interested in carrying on the discussion, there's my contact information. Whether you agree with me, disagree with me, does not matter. This is one person's view on corporate governance and trying to improve shareholder value. But again, at a minimum, even if you disagree with it, my hope is that it gave you some food for thought. So thanks for tuning in, and we'll see you next time.